Hello, everyone, and welcome to another Wall Street from Main Street podcast. Joining us today will be Mark Thomas, author of SilverpriceAdvisor.com. Mark, thanks for coming on.
It's great to be here.
All right, well, first thing I want to get into, which is basically like the news of the week. I wrote an article last week on December 8th, and I thought it was pretty obvious they had to do Treasury debt monetization. And silver had a big price that day. It went up, and now it's gone down Thursday and Friday. I have a question. What is your views on the QE4, basically? What it's going to do for silver and mining stocks in the short term and in the long term?
Well, in the short term, the market has gotten a lot more used to this now. It usually runs up ahead of it, and then no matter what the announcement is, if it's ahead of expectations of it or not, they sell it off. And that's just the nature of hot money and short-term people. I put out in my newsletter that, expect a couple days of selling after it. I guess that was Wednesday, and we had Thursday and Friday. We might have another day, Monday or Tuesday of it, and then I think we'll balance ourselves out. Longer term, it's nothing but bullish. I mean, they print $85 billion a month of money and put it into the liquidity in the currency system. It's bullish. I'm a little bit stunned by all of this, to tell you the truth, because they keep trying to say different things about what their goals are and everything, but they just won't really, frankly, be honest with you about it.
Yeah, I definitely agree. It's always a different goal, different. They just did QE3, and now they're doing, QE4, QE. Pretty soon we're going to have more QE than Rocky movies, if you ask me.
Yeah, one thing that was interesting about what they did this week, and it was a very important deal, and I only saw it written about in one place, and that kind of shocked me, was, before, when they did the twist, they're actually just taking the short term, and as it rolls off, investing into longer term, and that's the twist nature of it. But that wasn't actually adding liquidity into the system. It was just keeping it out there. Now, that's a big difference, and it's important because now they are formally buying mortgage-backed securities each month, and they are now formally buying new long-term securities, and not because they own so much of the short-term securities now, they don't have an available pool for it. So they are formally buying long-term ones now, and that again is injecting new money into the system. The reason that's important is it was kind of misleading when that was out there without the mortgage bond buying. That part of the QE was actually not injecting new money into the system, and that's why if you look at their balance sheet, it wasn't expanding. And I think that's actually the reason why that you saw a long pause over about the last 6 or 9 months, and especially since the peak of silver in 2011, where it's really just traded in a range because it basically is following the outstanding money supply in America.
Yeah, that's actually an interesting point, and yeah, it seems like a lot of money is being hoarded.
The reason I bring that up is, the media, they call me and ask me for a quote. Well, why is it doing this and this day? Da da da. That's kind of silly when you have that big of events going on and that big of numbers going on and the power that the Fed has and everything. It's really silly to focus on what the market's doing every day or something like that. Just look at the trend that they're doing over the next few months, year, etc.
Yeah, and one other thing also is what I think with this new tax selling loss, and I'm seeing a lot of people just liquidating gains because they don't know what taxes are going to be. I think one thing for sure is that they're going up. I think this is also one reason that after QE3 and now with QE4 there hasn't been a really big upward trend, is because of the heavy tax selling pressure. What are you seeing anything of this in the market, or?
Well, I think that's irregardless of the QE. First of all, I mean, I've written for a while that expect some selling in December. When we went into it at 33.50 or whatever, 34 near it at the beginning of it, You knew you were going to take a hit because, number one, you're in an asset class that's up 21% year to date at that time, and anything that's up 21% where it's prone to tax selling. And when I say tax selling, this is a little bit different this year. Normally, everyone's interested in tax loss harvesting and everything, and this year it's the opposite. And they're so dumb in Washington; they didn't even think of this. That think about it. You can sell, lock in your profit at the current rates, and then turn around and buy it. And normally when you do it for a tax loss, you have to wait 30 days. So you take the market risk of it moving against you and have to actually take that risk. Now you can turn right back around and buy it, and now you've got a new stepped up price. The only problem with that is you've also now paid taxes on your gain. If it went back against you, that would hurt you too. But there's definitely some tax selling. But I'll tell you, I think that there's more the hot money aspect of it. Hot money that's up 20% in an asset class, and it could be, obviously they might not have held it all year. It could be up, down, whatever, up more than that, less, etc. They're going to be prone to taking gains. The institutional money managers are so driven by their monthly, quarterly, weekly performance versus indexes and everything. They are going to be moving money around all the time, and we live in such a short-term society now with that effect right there is probably larger than the tax thing of it.
Yeah, that's actually a good point, and we definitely do live in short-term profit-driven markets. If you look at it, sometimes money is going to move out of silver just because people, they're taking gains and they're taking profits regardless of the month. I definitely agree with that, and sometimes Treasury bonds are even going up because of that, and short-term because just there's a little bit of a sale. They need to make quarterly profits. Do you see that going around just in every asset class?
Yeah, there's a lot of it in every asset class, but I'm not focusing on it that much. I think it's hilarious what's going on right now, because you're going to see so many people exercising such large gains and everything to go ahead and put it into this year where they're sure what the rates are. It's not so much in silver and everything, because you never get the longer-term lower capital gain rate on it because it's a collectible. You're up there at the 28 rate, I believe, no matter what, whether it's short or long-term or anything. The other asset classes, a lot of them, if you've held more than 1 year and you get the 15%, that it's a big deal there, because number one, it's going up from 15 to 18.8 with a 3.8 Obama healthcare tax. And then it might go from 15 to 20 or 25, so you literally could go from 15 to 23.8 or 28.8. That's what's causing a lot of the real selling in other asset classes. Plus, look at the financial markets right now. What you're looking at is almost insane. You've got high-yield bonds that are at excessive prices. You've got stocks that are floating on a sea of easy money, cheap money, liquidity. All of the financial markets are distorted right now. The bond market is penned in and repressed and totally driven by the Federal Reserve. Really the only things that aren't totally driven by those policies are the precious metals markets, and they are in a sense too. This is, first of all, people should be taking gains and harvesting them, and not only that, setting them aside and taking them off the table even when they go back in to reinvest and everything, because, it is a distorted financial world right now. And I really think it fools a lot of investors, a lot of people, and more than that, a lot of financial professionals in the industry. They only see what they're looking at on the screen, and they don't think about it in real purchasing power of their dollars or any of those concepts. They just know that things are up and have gone up, and there hasn't been a lot of volatility, and the clients that they have been able to keep in something because they haven't totally given up on the system and how corrupt everything is and everything, they're just myopic in that sense.
All right. And I actually wanted to switch topics right now about silver demand. How much demand do you see? Do you see it increasing? And what do you think will be the main driver of this demand? There is a lot of usages, but as people are, central banks are printing money like it's going out of style all over the world, you also see people going to precious metals for protection. So where do you see the main demand drivers, or is it a combination?
Well, it's definitely a combination, but I've been following the precious metals for just a few years now and studying them pretty carefully, and especially silver. And when I first got interested in silver, I really did think that the industrial demand was a driver of it, and things like that. Now, industrial demand grows, and the mining growth is relatively slow, so it barely keeps up with it. But the fact is, there's about 1 billion ounces a year available of silver from mining and recycling, and there's only, I don't know, 400 million ounces used in industrial demand. The rest of it's silver, jewelry, everything. But I've come to the conclusion, and this is backed up by a lot of research and numbers, that there's one single thing driving silver prices higher. It's investment demand. When they created the ETFs in around 2006, if you'll notice that even though gold started to take off from 2002 to 2006, silver didn't very much. And in 2006, all of a sudden, silver strengthened. Now, in 2006, that was the peak in the economy and the world economy. So why would it take off from 2006 to 2011 if it was driven by industrial demand? It's not. It's driven by net new investment demand. The reason this is happening, and it's happening more than in the gold market, is the silver market is very small. It's thin. It's like having a blue chip stock, IBM, and some small technology stock with a very small market cap of 5 billion or something compared to 100 billion. The available silver market, if there's 1 billion ounces a year, that's only a 30 billion, 32 billion at today's prices. And unless you drive the price up a lot higher, people won't come in and sell what they have because they're pretty solid owners. That is what is driving the price of silver higher. Now, there's also the other fact that there's a huge short position in the market by the bullion banks who help run the market. And if that ever gets out of balance, like it did from January to April 2011, the price shoots higher in a massive short squeeze. That's exactly what happened back then. That's all it was a massive short squeeze. So you have a market that's thin, it's heavily shorted, and you have net new investment demand sopping up all of it and taking that off the market, because when those investors either own it physically or in a physical ETF, they take it off the market and set it aside. So what it does is it sets the price for a marginal ounce of silver, in other words, the next ounce of silver. And that is just slowly, consistently going up. And it does it in fits and starts, and yes, it's very violent. It moves 300% more than gold and everything, but it's just consistently moving higher, and I don't think it's over yet. I think the short squeeze in January to April 2011, it really ruined it for a while, and it hurt a lot of investors who came in late, which is what you don't want to happen in a big bull market. But I think it's going to approach those levels again. In 2013, I think it might hit $42, and that's about 30% higher than where we're at right now.
So you say in 2013 you'll hit $42. I was wondering, what do you think the miners will do this year?
Well, the miners it's just a difficult area to predict. First of all, they'll follow the price of silver in general. The silver miners, they have one great thing going for them. They're not over-owned. They don't have too high of expectations like the gold miners. I absolutely abhor the gold miners. They never perform. Even if you have a great performer fundamentally, it doesn't seem like it does anything. They have serious challenges. and everyone looks toward those stocks and everything. But in the silver, because silver is such little followed, you know, then a subset of that is the silver mining stocks. There's still opportunities there. I like the opportunities in the, you know, the larger and mid cap ones and everything. I see opportunities there, but they're trades. They're not investments. You know, that's one of the problems that people that follow precious metals do, is they try to make everything investments and everything. I like to trade them. I mean, these are hugely volatile things. Silver's 3 times as volatile as gold, and silver miners are more volatile than silver.
Yeah, definitely. I always say silver is gold on steroids, and then the miners can be silver on steroids if you get the right one. This upcoming year, 2013, you said you had a new strategy. I read about it for trading or investing. Can you tell our audience a little bit about it?
Yeah, well, first of all, you know, at SilverpriceAdvisor.com, one of the things I try to do is I have an ETF metals portfolio, and I try to keep the level of investment at different levels at various times according to what I think that the market price is either higher or lower relative. So what I try to do is I try to trade it more than just a buy and hold investor and then outperform what it does annually. Now that's hard to do because you pay a lot of tax and some commission and everything. But one of the things that I do is, like, I might only be 50% invested at a certain point. Like right now in the ETF model portfolio, I'm 50% invested. What I'm doing new for 2013 is the last few years when I was in silver, I was always long silver in US dollars. And what I mean by that is when I buy the silver in an ETF, etc., I buy it with US dollars. Well, I've come across this opportunity with the Japanese yen where I think it's very overvalued. And now this isn't, this is a widely sort of known thing by hedge funds and everything, and I don't usually like to do things that they're doing, and I don't like to do complicated things like this where I'm using something else to be in another currency. But right now I'm literally 50% long silver and 50% short, the equivalent, of 50% short the Japanese yen. And I had to use 75% of the cash in the account to do that because I'm using an ultra-short leverage ETF to be short the yen. But what this in essence makes me is 50% long silver and 50% short the yen, which makes it to where I literally have bought my silver in the yen, and I'm betting that the yen will fall. Now, the yen has been falling, but it's very significantly overvalued, and Japan is a country that is in serious trouble. They're probably about where we would be in 10 or 15 years, the way we're going. There's a great presentation by Jeffrey Gundlach on this, on Business Insider. I think that's the name of the thing. And him and Kyle Bass, who runs Heyman Asset, these are two guys who both profited from the subprime crisis and are brilliant guys, Bass has been betting against the yen for a while, and Gundlach has just come out lately and done it. There's an election Sunday in Japan where a new prime minister might be elected, and he is openly advocating money printing, I guess the equivalent of massive quantitative easing, because the currency is so high now, it's killing their exports. You know, there's so many bad things going on in Japan. They have to import a lot of oil now since they're moving away from nuclear after Fukushima. They've got to rebuild. The society, the demographics are horribly gone against them to where I don't even know if they're replacing two people for two people. It's the aging is just incredible. The debt to GDP is about 230%, which for an industrialized economy, I really don't know how it functions at that level. The main reason they're able to do that is the people all save in the postal saving system and everything at very low rates, and they literally owe their money to basically themselves instead of most of the rest of the world. But what's combined with this is, with all the trouble in Europe and all the fear worldwide about solvency and there's a lot of money that have come into countries like Japan, Germany, and the United States, and it's put their currencies up a little higher, and especially the yen. The reason I'm doing this is if the yen falls 5 or 10%, I could get a big additional performance on my silver. So if silver wound up 20% up for the year, I might be able to get 5 or 6% extra performance from it. And that's why I'm doing it, and I'm really excited about it, to tell you the truth. Now, this is something that I have never done before. I'm going to be straight up honest with you. I'm not someone who plays in currencies, and I'm not an expert in the thing and everything. But I think it's a thing to consider. And I'll be honest with you, you know, Dennis Gartman has advocating this in long gold. You know, he used to be long gold in euros and now long gold in yen and everything. And it just performs better than in dollars. And I've combined that with the idea from the other big minds on Wall Street that I think this is a interesting thing to do. I might be a little bit wrong in the sense that I'm doing it with silver and gold rather than gold, because gold is so much more a store of value than silver, you know, on the day-to-day trading of it. But I think it's going to be, I really pride myself on trying to do something that's going to really outperform other than just the market timing. And I think this is the move for 2013. And that's the kind of thing that you get from my newsletter, silverpriceadvisor.com, which is basically an email update service. You get different kind of ideas, and you know, this kind of idea here, you don't even have to have a margin account and worry about things like that. You're just long one item and long ultra short ETF on the yen. So I do it in a way that I always do things that any investor can replicate in any account.
All right, and I guess I do get those emails frequently, so I will say it is a good update service. I encourage people to go look at it for informational purposes. And if people want to find out more about you, how can they do so?
Well, you can go to the silverpriceadvisor.com website, and I offer a free 30-day trial of the email updates. And that's something that you want to do. You know, even if you're not a big silver investor, get it, start to learn about it. This is a big opportunity, and you know, I do this to share it with other people. It's not a big monetary thing to me or anything. I do this to share this with other people because I really think this is one of the best opportunities I've come across in a lot of you. I've been in this game for about 20 years, and this has been one of the top 2 or 3 I've ever seen.
All right, great. Well, thanks for coming on.
Well, thanks for having me, John. I look forward to being on with you more and for your listeners to hear from me regularly.
All right, thanks. We look forward to having you back on.